Hey, how's it going, everyone? I wanted to go through today four main important accounts that kind of help you in saving tax. And everybody kind of asked me that, hey, as individuals, like, how do we save tax? So these are very important accounts. They are slightly different in nature, but it's good to understand how they work and how you can save your taxes. So let's dive straight into the examples. The four accounts that I'm going to walk you today are like the first one is the TFSA account, which is tax-free savings account. Second is RRSP, which is your registered retirement savings plan. Third is your RPP, which is registered pension plan. Fourth is your FHSA. This is a new account introduced last year, which is known as first home saving account. Now, let's take an example so that you know how these four are different from each other. So, number one, say a person is earning $150 a year. Okay, and you can take a screenshot of this and keep it on another page while I walk you through the numbers. So say he's earning $150 dollars, and say we invest 20, 20, 20, $20 in all four cases. So say in a TFSA, RRSP, RPP, and FHSA. What happens now? In your TFSA, you don't get any tax deduction for the $20. Okay, so you're not getting any tax deduction. In the other three accounts, you're getting a tax deduction of $20. So 20, 20, 20. What does a tax deduction mean? It means your net taxable income in your TFSA straight, it's still 150. But however, in your RSP, RPP, and FHSA, it's reducing your income. So from 150, you're actually paying tax on 130 right now because of the $20 investment. So C is nothing but A minus B. So in your TFSA, what's happening is your taxable income is the same, but in the remaining three, it's reducing it to 130. Now you're paying tax on 150 in your TFSA, which is $45, but in the remaining three, you're paying it at 30% of $130. So that's $39. So you see there's a straight up savings of $6 in your TFSA versus your RRSP in the tax perspective, from a tax perspective. So what happens is when you look at your in hand amount, like what is there in hand? So you see 150 minus 45 is 105. However, in situation in like in the other three situations, you see your in hand is lesser. And what people do is the major mistake they make is like because your in hand is less, they choose not to contribute to the RRSP because they feel that RSP, RPP, or FHSA, they feel that hey, I'm getting only $91 in hand. It doesn't really make sense. They only look at the $105. Now, the problem with this is they forget to include the $20 also as your investment because it's $91 that you have cash in hand plus $20 of your investment. So technically, what you have in hand is 111, whereas in this case, you just have 105. So what's happened now in this case, because you have only $105, the $20 that you've invested technically is coming out of the $105. You're not getting an extra tax break because of investing over here in the TFSA. But in the RRSP, RPP, and FHSA, you're getting the $20. You're getting the $20 as a deduction, which is reducing your income, and now it's at 111. So I hope this makes it a bit more clear. But now you'll ask me like, hey, what's the sense of all of this? Like, if TFSA is not giving me any benefit, why should I even invest? So good question. So say tomorrow now we take this example further of this $20 now becoming $25. Okay. So in a real world scenario, 25 minus 20, $5 is your capital gain. This will also be taxed in a normal account, but in the TFSA this amount won't be taxed. The $5 you can basically grow this 20 to, even if it becomes $200 tomorrow. So say 200 minus 20, $180 is your capital gain. It will not be taxed. So this is the one benefit of investing in a TFSA. If you're a good investor, if you can make money, your capital gains is exempt. There's no tax on that. But make sure you're not using it for trading. You're not continuously buying and selling. You're just investing. Now, in your RRSP, you can look at the tax savings like 105, 111, 111. So it kind of saves $6. And the quick way to get this $6 is just do your investment amount, $20 times the tax rate, so 30%, so $6. So you've actually saved $6 of tax. Okay. Now, what we're also doing is, now let's assume after 1 year the $20 has become $25. So as I said, in your TFSA, the 25 minus 20 is not taxed. It's not, there is no tax. Same in all the four accounts, technically there is no tax. In your RPP, your pension, okay, this account is only used for retirement. You cannot use this for anything else. This is technically, it is used for your retirement, but you can withdraw it by paying some tax. Same with this FHSA, you can use it for first time home buyer, but you have to pay tax when you withdraw it. I'll go into more detail. So what happens is, now we're again going back to, is there a tax on sale? So no, there is no tax. When you sell from 25 minus 20, there is no tax on this. So all of this, there is no tax. Now, when you withdraw, now what happens when you withdraw the $25? Say the 25, now you want to withdraw this from your TFSA account. Is there any tax? No, there is no tax. When you withdraw it, there's no tax. Okay, so what is happening here is, when you withdraw the money, in this case, there is no tax. In this case, when you withdraw the $25, now last year, you remember, you've got a deduction. So from 150, it's gone back to 130. Let's assume in year two also you're making $150. Let's assume your year one and year two income are the same. Now what is happening is, because you withdraw this amount, you've withdrawn the $25 in this case, your income is actually increasing. So whatever you had minused over here, the 20, now they have going to add it back. So the $25 is actually adding it back to your income. And now guess what? You'll be paying tax on $175. So, whatever you have saved in the next year, you have to pay it back the moment you withdraw. So basically, the concept is same with the FHSA. The concept is that you try not to withdraw the money, and they want you to kind of use the money at retirement. In an RPP, you cannot withdraw. So then this is like, it doesn't, like, this example is not, valid. Whereas in your TFSA, no, because, sorry, this was an error. In your TFSA, you do not get, like, nothing. There's no tax. So the investment, you had not got a deduction at the time of investing. So at the time of withdrawal also, it still remains the same. So, basically this $20, you can do whatever with it, but you're not getting taxed. Now, what are the annual limits? This is very important, because you need to know your annual limits. In a TFSA, you can choose up to, like, investing up to $7,000 a year. And you can look at your CRA account also. I'll go through that. So $7,000 is the recent 2024 limit. In RRSP, it's 18% of your previous year. So make sure that in the first year of landing, you're not contributing anything to your RRSP, because otherwise there will be a penalty. So in this case, if you make $150 in year one, times 18% is $27. So you can contribute to the maximum of $27 in year two. So make sure that you can contribute, that you're kind of taking a look at your 18% limit. In this case, we have assumed that, okay, in the earlier year also, the person is making money, just for an example. But technically, if this would have been the first year of the person, then they should not have contributed by law. But this is just an example again. Um, in your RPP also takes into consideration your RRSP limit. So make sure that you know your RRSP limit, and you can deduct, like in this case, your $27 like, if you're investing the money in an RPP, make sure that you have RRSP limit, because your RPP and RRSP limit are the same. So the total of that should not exceed $27. So you can do $20 over here, $7 over here, but you cannot do more than $27. And your FHSA is again a bonus, because you get 8,000 per year, and a maximum of 40,000 for a lifetime limit, for a lifetime limit. So it's 8,000 that you get extra over your RRSP. So this is a really, really good tool because it reduces your income by $8,000. And say you're in the 30% tax bracket, you have straight saved $2,400 in tax if you're kind of using the FHSA account. Now the HBP amount. HBP is nothing but home buyer's plan. So in the TFSA, there is no such home buyer plan because anyways you can withdraw the money and do whatever you want. You're not taxed. But in your RRSP, now you have $35,000 that you can withdraw from your RRSP for tax free, which can be used as your down payment towards your first home. So this is a very, very powerful tool. And looking at today's, interest rates and the housing market, like 35,000 is a small amount, and they are proposing to increase this amount to 60K. So imagine like 60K, you have a 60K limit where you are saving tax. So say, let's say 60K times 30, you've saved $18,000 in tax, which is superb. And plus you can combine this with your FHSA. So say 60K plus 40K, that's about 100K that you have as a down payment tax free, which you can save almost 30%. So that's $30,000 that you have saved in taxes by using your RSP and FHSA smartly. Okay. Uh, your HPP amount, there is no, like, you cannot withdraw. I'll just put it here. Like, you cannot withdraw your pension for home buying. This is only for retirement. So sorry, you cannot use this for anything else. Okay. And if you don't end up using your FHSA, say you don't buy a house, you can always transfer this amount to your RSP. So yeah, technically it's a win-win situation in both cases. What happens if you over contribute? Now in this example, as I said, 150 times 18%, you had 27K, say you contributed 30K. Okay. Say you contributed 30, so minus 30, so you've contributed by 3K over. Now, what does the CRA do? It penalize you for 1% per month in excess. So you're paying $3,000 times 1% each month for over contribution. So make sure that you are very clear with your limits and don't over contribute. There are also situations where you can ask for an employer match. So, like in my case, my employer matches me for a TFSA. I can buy ESPP is nothing but employer share purchase plan. So I can buy my company's shares in the TFSA and say tomorrow they grow, I can sell it without any capital gain or loss. Like without any capital gain, I don't have to pay tax on the capital gain because I'm investing in the TFSA. Same with RRSP, but RRSP I can buy ESPP like my share purchase. Plus, I get to transfer like my bonus. So if you have a bonus that your company is giving, make sure that you can, take the money in your RRSP account. Also, see if your employer is matching. So some employers might, like my previous employer was matching my RRSP account. So that's good. Same with RPP. The pension, like my current employer matches my pension also. So it depends. You can do a mix and match of everything, but make sure that your limits are you are within your limits. And now you want to see like how your limits look like. Your FHSA, the employer does not usually match because this is like given to you as an extra bonus. You have to contribute to it on your own. Now you can look at the limits. So when you go into your CRA account, right, like this is what you see. So this means like the 19,000 what I can contribute uh for 2023. For last year, this was my limit, like 19,574. And for 2024, I can contribute about $25,000. So I have to make sure that if I contribute, I don't over contribute to this. Yeah, I don't have that much money, but then yeah, just in case, like whenever I am investing, I don't have to contribute more than 25,000, like at one shot or over the year. I have to be very, very careful. And these amounts, they don't include the transactions for the current year. So make sure, like when you click on this important information, it gives you like the CRA reports these numbers as of 31st December 2023. They don't have any current year information. So I have a special spreadsheet that I keep where any contributions that are made to these four accounts. In my case, the FHSA is not applicable because I already have a house, so it's only for a first time home buyer. If you are buying a house for the first time, so I kind of play around with these three accounts. But yeah, most of you are, if you all are first time home buyers, you can also use this account very, very powerfully. And I have a live example where one of my clients have used the FHSA and RPP like fantastically. I'll show you their example right here. So if you look at it, this is the husband and wife. For 2023, they've made 28,000. The other person has made, the total income has been 53,000 for the total income. But now look at the deductions from the total income. So they've used out their maximum FHSA account, one person. The other person has used out 8,000 plus 4,000 of pension. So they've used actually 20, sorry, 8 plus 4, 12,000 of their, for their deductions. Now look at their net income. So their gross was 28, but now their net is only 19,000. And in this case, the net is only 41,000. They have brought down their income substantially, almost a group in joint investment of $20,000. And now see what has happened. The total payable for them is only $173 and $4,600, and the total tax deducted in this case is 3,600, whereas there is 9,000 deducted in the second person. And look at what's happening. The refund is superb. Like this person has got a $3,600 refund, whereas this has got almost a $5,000 refund. And the best part is they have invested this money. So what's happened is, like, say 8,000, first person has invested 8,000. If you invested in a tax-free GIC, you're getting 5% as of now. So you're getting interest also on this 8,000. So this has become 8,400 at the end of the year. Same with the second, same with the pension. So they have earned at least $1,000 of interest, and this is their tax refund. So this is 4,942. This is 3,600. So totally, they have got about a $30,000 portfolio sitting at the end of the year by just using these accounts smartly. Like this is superb tax planning, and like if you can use these accounts to your advantage, it's there is nothing like it. So make sure that you, whenever you have these benefits, like make sure you're making the best out of it. Make sure, like, you kind of look at your company, ask your employer if they are giving any matching programs. And a lot of people in their jobs, they don't take these programs, don't use it because they feel that, hey, it's just a deduction from my salary. They make the most common mistake of looking at the in-hand salary, but they forget the total investment. So you don't have to look at just your in-hand, look at in-hand plus your investment. So look at not just $91, but 91 plus the 20. So I hope that you will put into application what you've learned today, and yeah, you will be able to see the effect, like this people, like this these clients at the end of the year. Hopefully, yeah, hopefully you practice whatever, put into practice whatever you've learned. Thank you, have a nice day.